Okay.
Welcome to Markets Today. I'm your host, Mbithe Mwema. Now, we have been taking you through different asset classes over the last couple of days, and I do hope you can be able to go over to the Metropole TV page on YouTube to just get a sense of what the professionals and the insights that we were able to glean in as far as equities are concerned, real estate, and fixed income as well as bonds are concerned. Today, we want to take a new perspective and look at derivatives. Derivatives and gold are considered good assets in terms of hedging when there's a lot of volatility in the market. The Nairobi Securities Exchange launched the derivative asset class last year. We are joined by the Chief Officer of the derivatives market at the Nairobi Securities Exchange, Mr. Terry Adembesa, who will be taking us through what is happening in that market and what opportunities does the current volatility in other asset classes portend for this asset class. Welcome to the show, Terry.
Thank you very much, Mbithe. How are you?
Oh, thank you. So what is happening in derivatives and how does this tie into what is happening on the equities?
Thanks, Mbithe. I think it'd be best we start with an introduction, which I think you've already done. I'm sharing my slide. I don't know if you can see it, but basically, these instruments, are contracts pegged on underlying securities, and in this case, in Nairobi, we have underlying contracts on the index, the NSE 25, and on some select single stocks, which are selected based on a certain criteria, mainly based on their liquidity. So we have about 6 or 7 of those securities. The contract itself, it's just that it's a contract. It's not a physical asset. Something that people usually would struggle with understanding. Key differences between the two markets is that, unlike in the spot market where you pay the full amount for your security. For example, if you want to buy 100,000 worth of, you'd have to pay 100,000. Else in the derivatives market, you'd pay a portion of that, which we call initial margin. Your daily profits and losses are credited and debited to you on a daily basis. In the spot market, this is only actualized when you actually sell or buy a security. Those two are key differences. So in the spot market, we settle on a T+3 basis. In the derivatives market, we settle on a T+1 basis. And these are key for you to, for investors to understand before they get into these markets. Some key terminologies: what is volume, what is open interest. Volume is really what the number of contracts that are traded. Open interest is a number of open positions. So you're able to buy and sell during the day, but if you buy and hold the security overnight, then that's called open interest. So one of the things that you want to check in a performing market is how many contracts are traded, how many contracts are open interest. Open interest also means how much money is held as margin, in the system. Because if you trade in and out intraday, you don't necessarily have to the margin is not held by the exchange or by your trading member, because there is a offsetting position on the contracts.
So very good terms there and very good insights, and thank you for sharing that. I literally feel like I should have been taking notes of each and every single slide. But out of curiosity, the derivatives market today, who's trading in it? Is it the retail clients? Is it the institutional clients? Have you seen increased activity based on what is happening of the COVID pandemic?
We're seeing mainly high net worth and retail clients. There've been a few institutional trades, and the basic reason is that you know how the institutional portfolios work in this country is that they require investor what we call investor trustee approval before they can participate in this market. So that some of those approvals haven't come through yet, and they're still being processed. But we're seeing quite a bit of activity by the high net worth and the retail clients.
So when does it make sense for my portfolio as Mbithe to look at derivatives? At what point? And why would I actually want to put money in derivatives?
It's what positions you're taking both on the spot market and on the derivatives market, right? If you're long the security, the underlying, and you want to hedge that position, then you consider taking a short position on the derivatives market. So
I've had long, I've had short, I've had spot. I do understand these terms, but perhaps there are people who are watching us. Could you break it down for us? So when you're saying you're long on a particular asset, what are you doing?
So the first, let's start with the distinction between the cash market, which is the spot market, and the derivatives market. So you'll hear me say a bit, distinguish between the spot market and the derivatives market, okay? The spot market is what we are used to. You buy a security, you hold it. When you're ready to sell, you sell, okay? The derivatives market is not what
I buy Safaricom and I hold it, and if it's yesterday touched a high of 30.4, then I exit the stock if I want to, correct?
Exactly, and that's the spot market. The key difference is really around the delivery, right? When the delivery.
The Safaricom derivative look like? Maybe you can walk us through. I come to the market and I want to buy a Safaricom derivative. How would that look like? How would that transaction look like?
So how we do it is we have positions on particular contracts. So and it's not a 1-to-1 match, it's a 1-to-1,000. So you'd buy a contract that's worth 1,000. That's pegged on the 27, well, the 30 for example's sake. If it closed at 30 and the contract is worth 1,000, so you'd have 30,000. And then the contract size is 30,000. That's a notional, but you'd have to pay a margin of that 30,000. Okay, the margin in this case would be in the whereabouts of 3,000, approximately 10% of the notional value of the contract. So it gives you exposure to 30,000 worth of value, unlike on the spot market, which it then means you'd be buying shares worth 30,000, and you'll have to do an actual outlay of cash of 30,000.
Okay, fair enough. And now that global markets, we have seen equities coming off. For the NSE, it's a mixed bag. Safaricom is holding up there. We have seen a bit of downward correction on the banking prices. How would I position in a derivative today, say if I wanted to trade in the banking derivatives?
Let me just show you on the slide around ESCOM and what has been happening on ESCOM between July and April, right? You can see there's been some upward trend around there. There's a dip there in November, December, and then another upward trend between December and February, slight dip, and then another big dip between February to April, and then we see an upside. So what happens is that if you're long on the security and the underlying goes up in price, then you make money, right? And the vice versa is the same. So if, for example, you are you are long during the February to March rally, then you'd have lost money because the underlying lost price, right? But if you are short on the security, if you had sold the Safaricom contract between February to March, then you'd make money. How it works is that if you're long on a security and the price goes up, then you make money. If you're short, you lose money, and the vice versa happens as well. So you can clearly see if you are short on Safaricom, if you are short Safaricom between February and April, then you'd have made money on the security, and the vice versa would be, if you are long between March and April, then you'd be making money on that contract.
Interesting chat. And if I understand what you're saying, is if in February, once COVID started, rather than selling my actual stock, it would have been better to take a derivative and to be able to sell that derivative instead. Is that the case?
Because remember, a number of investors are on the underlying are mainly buy and hold portfolios, right? They don't necessarily would take the dip and sell out during the dip, right? So what you want to do is hedge out the price decline during that period, and then by buying a Safaricom contract on the derivatives market, you can short Safaricom on the
okay.
Exactly, which hedges, it sort of hedges your decline on the price if you're holding the underlying security.
And now that we're seeing the banks coming off on price, what should I be doing today if I want to look at, say, KCB or Equity Bank?
And the concept is really the same. If you're bullish on the security, that the assumption is that you'd be buying the underlying, right? If you're bullish on the underlying, right? If you're again also want to hedge that portfolio, then you'd want to short the security just to hedge out your potential loss in case the security actually declines in value, in price. But if you prefer to hold the security and keep cash, then you would trade on the futures product, on the futures contract for KCB, for example. And if you're bullish on it, then you go long on the KCB contract.
To come off, then what would I be doing in the derivatives for KCB and, say, equity?
So if you're bearish on the security, then what you'd be doing is going to the spot, to the derivatives contract and selling it. Okay, and then you sell the derivatives contract. The assumption is that, of course, based on your research, you have a view that the price would decline, right? So what happens is, if the price actually declines, then you'd make money on the contract, right? If the price doesn't, of course, you lose money. So if you're holding the underlying, you'd make money because the price would increase, right? If you're long on the security, but if you're not, then you'd lose money. So I assume that based on your research, you would want to, if you want to sell KCB because you think the security is bearish, then you'd have to come and just sell sell the contract on the derivatives market.
Thank you so much for that overview. Terry, we take a short break, and when we come back, you can walk us through the other key tenets in as far as derivatives are concerned. See you in a few.